Once again, we are welcome to the second bit of the marginal and then break-even analysis. Okay, so we looked at how to compute break-even analysis, break-even points, and then the other dimensions in terms of margin of safety and then target profit. Okay, let's look into further angles of this particular analysis using graphical illustrations. Okay, graphical illustrations, and then also try to look at some other dimensions of operating gearing. Okay, so we all remember this chart very well. Okay, perhaps it's just a combination of charts. So you realize that our fixed cost stands. Okay, look at our fixed cost, it goes quite straight. Okay, regardless of the level of activity, our fixed cost remains straight. Okay, our fixed cost remains straight regardless of the level of activity. So our fixed cost will always remain fixed regardless of the level of activity. Whereas our variable cost will move in line with sales or let me say activity level changes. So a combination of our variable and then the fixed gives us our total cost. Okay, so the total cost will always be above the fixed cost. Okay, so you realize that at a point in time, our total cost intersects. Okay, our total cost intersects with the revenue. Okay, so perhaps we can just draw a simple dotted line here to tell us that at this point in time, when revenue was X amount, cost was also this. Total cost, a combination of both fixed and variable, was also this. Okay, so you ask yourself then, what does it mean, okay, to the layman? Anything below, at this point onwards, in this particular bracket, where the cost was higher than the revenue, what do we make? We make loss. So the whole of this is the loss region. The whole of this section is a loss-making region, okay? Is a loss region. But at this point, when total cost is lower and then revenue rises above it, okay? What would we say? When the revenue is above, this becomes our profit zone. This becomes our profit zone. So the point at which the cost intersects with the revenue is where we break even. This is our break-even point. So it is at this point of units that when we sell, we will not be making any profit, neither are we going to be making any losses. Okay, perfect. Let's continue building our case. So the break-even chart tells us clearly the level of activities, revenues, and cost, okay, and which point we need to produce which a number of units in order to make zero profit or zero losses, okay. And so it occurs where total cost meets total revenue, as I explained on the graph. And on it, we saw the coordinates or the plotting of fixed variable total costs, and then the sales revenue, okay. Useful, always it is useful for us to be able to plot this on the graph if we only understand how the cost behaves, okay. And we looked at this in our earlier scenario where we talked about the cost behaviors, fixed variable, and the total cost we said has a behavior of what? Semi-variable cost. Okay, so the same scenario here. So it is useful to plot these costs at different levels, look at zero sales, break-even sales, and anticipated demand of sales. Okay, so let's take another example here. Let us assume that sales, we are using our old scenario where 219 units will give us a break-even. Okay, you remember that scenario which we look at approximately 219. Okay, so if sales unit is zero, activity level is zero, will fixed cost be incurred? Yes. What activity goes on, what will be incurred? But would there be any variable cost? No. Zero activity level. So Even though the variable cost per unit is 44, it is 0 units, so it will be 0. Fixed cost still remains as it is. So total sales revenue, have you produced anything? No. So the selling price per unit, which is 108, will still be 0. So at this point, we will say that cost exceeds our revenue, 0. 0 revenue, okay, 0 activity level. So it's not a good point. Now, at the point at which we sold 219, fixed cost will remain the same regardless of activity level. It doesn't change. So multiply our 219 by the variable cost, and we make this, okay, per unit, okay, 219 units. That's the per unit 44 times 219 total units. So we get total variable cost of this. Now, total cost will become a sum of this plus this, gives us our 23,623. Now, our revenue at that point will also be 219 times the sales revenue, and realize that we're making the same revenue. So when total cost equals total revenue, break even, 0 profit, 0 loss. But when we increase the sales of units to 500, we made extra sales, okay, extra units of sales. Now realize that with the extra units of sales, fixed costs still remain the same. Okay, fixed costs still remain the same. But then our variable cost will increase because it increases in line with activity level. So 500 times 44 gives us this amount. Add it to our fixed cost, and we end up getting 36,000 as revenue, as total cost. But revenue then will also shoot up. So at 500 units we sell in, given a selling price per unit of 108, realize that we'll get good amount of sales. Knock them off, and you'll surely make a profit. Okay, will surely make a profit. So you can simply plot this on the graph. Okay, these are fixed cost of 14,000. Okay, the deep blue line, that's our fixed cost. Our variable cost and revenue, which rises together. Okay, and then we have our total cost, a summation of our variable cost, and then our variable cost, and then the fixed cost. So the point at which the total cost intersects with the revenue, this point, so roughly we can say is 219, gives us our break-even point in units. All right, very easy and straightforward, something we've looked at. Okay, so you can always sketch a graph using the estimate of the points on, and then find out your break-even. Okay, so let's take another example. Selling price is 20, variable is 12. That's all. Total variable cost of per unit is 12. Fixed cost is 4,000. Let's plot them. Assuming activity level is 0, what do we get as fixed cost? It still remains 4,000. Variable cost will be 0. So total cost will be 14,000, will still be 4,000. Okay. But what if we get 4,000 units to be sold? What do we get? Okay. So if we have 4,000 units, realize that fixed cost will still remain 4,000 regardless of activity level. But then the variable cost, remember, per unit variable cost was what? 12. So 4 times 12 gives us the 4,800. Total cost will be 4,000 plus the 4,800, giving us this. And I realize that sales per unit, sales is also 20. Okay, 20. And we're selling 4,000. So 20 times 4 gives us this. Okay, 8,000. So over here, yes, total cost is 8,800. Total revenue is 8,000. There's a loss region. We're still making loss. We are not breaking even. But when we sold 800, you realize that our total cost will rise to what? 13,600, whereas our sales revenue is 16. Here we make profit. That's a safety zone. Excess of it gives us our margin of safety. Okay. So margin of safety always falls within the bracket zone outside of the break even. Okay, within the profit zone area. Okay. So we can also prepare using this simply to prepare our marginal costing sheets, okay? And then we make various decisions based on the outcomes that we have. Let's take two different scenarios, current activity level, and then the marketing department gave us a proposal. We are weighing these two options. Let's see which one works well for us, okay? we are weighing these two options. Let's see which one works well for us. So in the first scenario, we are being told, that the current sales unit is 1,000. Okay, selling price is 250, material cost, labor cost is 30 and 20. Okay, fixed cost together with utilities, administrative is 60, utilities is 32. Now they are saying that if we should increase sales, okay, they said advertise a price reduction. So let's reduce the price, okay, selling price. But then it will lead to sales increase of 1,500, not 1,000. It makes sense. Now, the resulting of price, it will also lead to, so when we reduce the price from 250 to 220, leading to 1,500, it says that material costs will not change, labor costs will not change, admin costs will not change, and utilities will not change. But then we'll have to incur extra advertising costs of 40,000. Doesn't make sense? Do your analysis. Okay, do your analysis and tell whether it makes sense. So the decision can be analyzed using marginal costing for each scenario, and the statement will show the contribution per unit under each scenario. You can find overall profit, and then the statement will highlight the fixed cost that must be covered by the organization. Okay, so it will clearly tell us our margin of safety. You can calculate margin of safety, okay, and then break-even point, and then tell which decisions to make. Okay, easy. Let's try and see. So in the first scenario with the selling price per unit of 250, and we will be selling 1,000, we make total sales of 250,000. Material cost or direct variable cost per unit, 20 and 30, multiply it by the unit cost of 1,000. This is what we get. Total variable is this, okay, 50. Subtract it from the 250, we get 200 as contribution. Per unit is 200, but total contribution with 200,000. Okay, so we can do the analysis both on unit basis or on total basis. At the end of the day, total contribution should be the same. We subtract our fixed cost elements and we end up getting profit of 108,000. Now with the proposal which has been made, reduce selling price to 220, the rest remain the same. It tells us that our contribution per unit becomes 170, but we sell 1,500 units. It means our total contribution ends up becoming 255,000. Subtract our fixed cost elements and we make profits of 123,000, even though we have to incur extra advertising costs of 40,000. From this scenario, it makes sense. So much sense to go for the proposal by the marketing department. Okay, now let's move on and see. So the break-even point, okay, in units, if we should divide it from using the current scenario, remember, current scenario is what? 60,000 plus 32 gives us 92,000 for fixed. Okay, and then the same scenario you can do for the blue. Okay, so the 92,000 divided by the contribution per unit, it means we need to sell 460 units to break even. Okay, 460 units. Multiply 460 units by the selling price. It means we'll end up making 115,000 to break even. Okay, margin of safety, we sold 1,000 under our current scenario. Subtract the 460 where we break even. It means we need to sell extra 540 units to fall in the buffer zone, okay? Or that's what we are selling, not we need to sell. That's what we are selling, and it gives us some good percentage. Now let's see the percentage of the margin of safety, and it's 54. Express the margin of safety, the extra unit we sell over the selling units or the units we sold, and then we get 54%, right? Lower profit, we made 108,000, lower profit, but the risk, okay, we look at the risk component. With the proposal which has been made, total fixed cost is 132,000 divided by the contribution per unit, which is 170. It means we need to sell 777 units in order to break even. Now, multiply by the selling price, the reduced selling price of 220, we get 170,940, okay. Find our margin of safety. We're subtracting what we are supposed to sell to make our break even from the 1,500. We get 723 extra units. That's what we need to sell compared to what we need to sell here, 540 units. Okay. Even in expressing this 723 as a percentage of the total unit we expect to sell, the margin of safety percentage is 48. Which one would you like? This is giving us 54%. It's giving us 48%. So even though the proposal is giving us a higher profit, there's a higher risk. There is a higher risk that will drop down in terms of the pecking order and making profits. But in the scenario where we're making 108,000, there's the lower risk. This is the scenario. So it's so interesting how we find management accounting. No one answer. It's not about precision. It's about flexibility and relevance. Remember, okay? There is an alternative plan which says that let us buy the unit from a supplier instead of making the units, okay? So the cost of buying will be 70 instead of 50. Remember, the cost of buying, they are saying, will be 70 instead of 50. If we were producing it, the variable cost we had was 30 and 20, 50. But if we should buy it outside, we are going to incur 70 as a variable cost, okay? Now, fixed utilities bills include 16,000 of production overhead. It will now be 0. So we will not incur any utility bills. The 16,000 will be gone. We will only be incurring the fixed amount, the administrative portion. Other data will remain unchanged. Prepare the marginal costing sheet, okay? So yes, selling price remains the same, 250. Labor, in our earlier scenario, this is what we got, 108,000. Let's use the new scenario to work and see. Still, unit cost will be 250, but variable cost in terms of we buying it is 70. We subtract, we make contribution per unit of what? 180. Initially, we were making contribution per unit of what? 200. Remember, 200. Okay, now, if we work all this out, we'll get a total contribution of 180,000. Fixed admin cost remains the same. It remains the same. It doesn't change. But then fixed utilities becomes 16. Okay, it reduces to 16. So at the end of the day, our profit becomes 104. 104. Okay. Now, sales remains unchanged. Cost of buying will be 70. Lower contribution instead of the 200. Admin remain unchanged. Fixed utilities will now be 16. It used to be 32, right? Now be 16. Now profit, compare it, 104, we're making lower profit as compared to the current scenario where we were producing the units ourselves at 108,000. The question is, do some analysis and see what are we saving. We saved how much? 16,000, right? We saved 16,000 in terms of the utilities, okay? In terms of the utilities, we saved 16,000, okay? But what about the cost? We are incurring extra. If we were producing, we would have incurred 50. But since we were buying, we were paying 70. So extra 20, okay? Extra 20 times the unit. It means we are going to incur extra 20,000 cost, whereas we are saving 16,000. Is it prudent? Compare it. Is it prudent? So this will not be prudent. So you tell the management, no. At the end of the day, when we buy from someone, a supplier outside of the units that we are going to give out to the customers, we end up saving 16,000. Yes, it helps, but we incur 20,000 extra costs. This is the beauty of management accounting, okay? So we should always be able to think outside the box and advise management accordingly and tell them this option is right, this option is not right. So it's so flexible, so interesting, okay? So we've looked at what relevant and irrelevant costs are. Importance of contribution, it contributes towards meeting the fixed cost component of the operations. And then we've been able to apply simple contribution techniques, analysis techniques to help us prioritize production and then provision of services. We look at the contribution per unit and contribution per limiting factor, and also how to apply break-even analysis in assessing business risk. We can easily plot it on the chart, on the graph, and interpret it using all the variables or the points in terms of which cost to plot and which units, where to plot the units and the revenues, okay? And surely we've known what operating gearing is. As usual, we'll give you 10 key concepts which you need to memorize or you need to get familiar with. Okay, Let's look at an appendix of operating gearing, then we wrap up. Okay. So assume we have an online shop and then which is automated, and then a manual shop. Sales revenue is 800 both ways. Variable cost for the online is 200, whereas for the manual is 600,000. Contribution will give us 600 for the automated or online, whereas that of the manual will be 200. Fixed cost for the online, unfortunately, is 450, and that of the manual shop is 80,000. So you end up getting a profit of 150,000 and 120,000 respectively for the online and then the manual shop. The question is operating gearing factor. How do we find it in terms of contribution per profit? Okay, so find the contribution per profit. Okay, so simply we can realize that if we divide these by the 150,000, we end up getting 4 times. But if we pick this particular scenario where we are dividing this against this, okay, or yes, against this, so 200,000 by 120,000, we end up getting 1.67 times. Which one would you go for? Which one is giving us a higher leverage, okay, or operating gearing, okay? So the cost structure will suggest that, yes, the online automated system will produce higher profits. This is only true when sales are sufficiently high or are increasing, but low sales levels make fixed costs more dangerous. Let's look at another scenario. Let's say sales revenue drops by 10%, both ways. We still get 720,000. Variable costs will surely drop because it will move in line with activity level. So all becomes 180, 540. But which means contribution will also drop by 10%. We get 540 and 180. Fixed cost will remain unchanged. It's not affected. So we end up getting overall profit of 90 and 100. Look at the drop. Just because there's a 10% drop in revenue in activity, the profit drops by 40%. But with the manual section, the 10% drop leads to only 16.7 drop in profit. So you realize that a higher operating gearing will lead to higher risk from greater volatility in profit and usually a higher break-even point, whereas a higher percentage loss in profits occurs when sales are decreasing by higher gains when sales are increasing. There's always a trade-off in terms of risk and return, so you must always choose. The higher the risk, the higher the return. The lower the risk, the lower the return. We might have heard of this over and over. Okay, perfectly done. So nothing so complicated in terms of break-even analysis. When we look at a tutorial, we'll look at some calculations, some computations, and you'll be fine. With the case studies there, you'll be fine. So trust me, nothing is so complicated about management accounting. It's quite lively and interesting, and it makes life more reasonable for us to make proposals and recommendations to management. Thank you. See you soon. Bye.